Today, we're going to be covering should I invest in alternative investments near retirement time? And one of the things I want to start with is I want to go back to a famous quote that Warren Buffett said. And what he said is, only when the tide goes out do you discover who's swimming naked. And that's kind of the theme that I want you to think about when we're talking about alternative investments. And I'm talking about things like private real estate, private credit, infrastructure funds, even commodities, precious metals, and cryptocurrency. Basically anything that is not your traditional stock and bond investment. And when we look at this, these investments are really being marketed right now, and the pitch usually sounds pretty good, right? Higher income, higher numbers, inflation protection, diversification. But are they right for those folks that are close to or in retirement time? And let's break down what the pros and cons are. Again, the pitch is simple. I see some of these ads on Facebook. I've had a lot of people that have come to events lately. They talk about some of these loans that you can get into that provide, much higher income than what some of the other traditional fixed investments that are out there. And I always caution them that you've got to read the risk. You've got to read the fine print. You've got to understand. I do understand that alternative investments sometimes can zig when the stock market zags. They do offer diversification. They do offer potential higher income. And they can help you fight off what is inflation today. All of that does sound good, but what I want you to do is I want you to make sure that you take a fair and balanced look at both sides. So here's kind of the case or the good for alternatives and why a retiree would maybe want to consider them. First of all, the simple word diversification. And I mean diversification besides a traditional stock and bond portfolio. Most investors are heavily tied to what the stock market does. And if you have a stock portfolio of 60% stocks, 40% bonds, the market hiccups, you can really feel it a lot. And what happens in the good old days, I'm talking 40, 50 years ago, stock and bonds oftentimes work somewhat opposite of each other. But today, because the shift has been the managers are traditional pension funds, to today, the majority of the money is managed in 401ks. Individuals, when they panic, they go into their 401k and they hit sell everything, meaning that they sell both their stocks and bonds, and they can become more correlated. So the diversification of some of the alternatives like that private real estate investment or commodities, they typically can behave differently than what the broad market does, ultimately trying to have a little bit more stability than when there's a bad day in the market. Number two, there is the potential for higher income. Many alternatives are really structured to deliver the higher yields than, say, your traditional bond fund. Private credit funds, real estate funds, they're all designed to provide cash flow. And if you're retired and living off of your portfolio, that steady income to your portfolio can be very attractive. But it's also important to understand that usually when you have a higher yield, what you're doing is you're dealing with one, illiquidity. So you're oftentimes in these private investments locking up your money for a much longer period of time. You've got to be careful about that liquidity. There's alternative investments on the market that you can get into that are publicly traded. So, example, you can have publicly traded real estate investments that are more transparent, that are more liquid, that are not private and less liquid. The third is you want to look at the issue of inflation protection. And this is huge for retirees because things are getting more expensive. Retirees are traditionally living on a fixed income. So alternatives like infrastructure or commodities tend to rise when inflation rises. And, they can pass through those price increases. So when the cost of everything goes up, these investments can help protect your purchasing power. But again, you have to be careful about how those alternatives work from a liquidity standpoint. Fourth is you get access to the private market growth potential. Many companies choose to stay private. Not all companies go and become publicly traded stocks. Some companies aren't going public like they used to. If you want exposure to some of those innovative growth companies, a small allocation into private equity or venture capital might be something that would be attractive to you and might be able to get you some exposure there. A fifth, they can help cushion out some of that volatility. Alternatives will work a little bit more independently than just the stock market as a whole. And during those downturns, they can help buffer your losses, which is both emotionally and financially helpful of not taking major losses when you get closer to retirement time. There's going to be risk and there's drawbacks, though. So, a lot of those things sound good, but here's the catch, and there's quite a few. There's several. Number one, illiquidity, as I mentioned before. A lot of these alternative investments, you've got to be careful and you've got to read the fine print. I want you to go right to the risk section and what the offering memorandum or prospectus says. And I want you to take time and I want you to read through each of the risks that are outlined inside of there. That's a big one. Most people miss reading through those documents, but those documents outline how that investment could work. And it's a good idea, again, if you take time, read the risk section in there. And then also read about liquidity, because most are illiquid and can lock up your money for years. I mean, we're talking, 5, 7, 10 years. I know of private real estate offerings pre 2008 that still are not liquid to this day. I mean, almost 20 years later, those investments are still illiquid. So if you're retired and you might need access to the money for healthcare, living expenses, emergencies, illiquidity can be a serious drawback. And that's why you want to kind of limit your exposure on what you have. And you want to think about, if you're going to look at alternatives, thinking about things that you have 5, 10 plus years that you can set that money aside for. Number two is complexity and transparency. Look, as somebody who's been in the business for 30 years, I have a degree in financial management. Unlike a mutual fund, a stock, or an exchange traded fund, where you get to see the price every day and you can look up a lot of information, non-traded investments can be much harder to understand, value, and really monitor. Prices can change quarterly. There's typically less disclosures and they can vary. And the result is it can be easy to underestimate the risk that you're taking or overestimate what you're going to actually make. So be careful about these investments that promote, here's what we've made over the last 3 or 5 years. Again, don't chase an investment based upon past performance. Number three is higher fees. Many alternatives are going to charge higher management fees. They're going to have the potential for performance fees on top of that. These fees can quietly eat away at your returns. You've got to make sure that those potential benefits actually justify the other cost. Number four, due diligence and regulatory risk. So alternatives are oftentimes less regulated than traditional investments, and that means the quality can vary widely. Choosing the wrong manager, the wrong fund structure, the wrong investment can expose yourself to unnecessary risk, or sometimes this is oftentimes in the alternatives where we see more of these fraud cases come about. And number five, tax complexity. Some alternatives generate different type of tax forms. I mean, one might be a K1 tax form. A K1 tax form, in my opinion, can be really a pain for the average investor, the average retiree, oftentimes delaying their ability to get their taxes done because of the K1. For those of you that have money invested in alternatives and retirement accounts, it could generate unrelated business income taxable inside of your IRA, again, complicating your tax situation. So the bottom line is to work closely with a tax advisor, work closely with a financial professional that can make sure that you help understand. So there you go. There's the question. Should retirees use them? Overall, alternatives can, make a plan in a portfolio. I talk a lot about the value of having an all-weather type portfolio, but just remember the alternatives can add stability and opportunity, but they can be more complicated and complex. And what I tend to prefer is using alternatives that are publicly traded investments. That way you can maintain more liquidity. For An overwhelming majority of retirees' alternatives should be somewhat of a small percentage of your portfolio. You still want to have a large part of your portfolio, I believe, in traditional stocks and bonds. The stuff that is illiquid that you don't understand, really you want to try to stay away from that. If your situation makes sense, make sure that you're developing a plan to figure out how it fits in there. So what I want you to do is I want you to make sure that before you invest, you ask yourself questions like, do I actually understand the investment and how it works? If not, don't invest, period. Number two, do I understand the risk associated with this investment? If not, make sure you read the memorandum, the prospectus, whatever the offering is, read through the risk category. Next, you want to understand, if it's an illiquid investment, you afford to lock up your money for 5 or 10 years. If you think you're going to need it sooner, stay away. Next, understand what are the total fees and expenses. A lot of the times in these non-traded alternative investments, they're not nearly as transparent as other investments. Don't just look at the yield or what the income is going to be provided. Look at what you're paying. Understand who's managing this alternative investment. What is their track record? The last couple of years have been great, so do your homework. Don't just look at a track record of the last couple of years. Check their history, check their reputation, check their regulatory record. And last is, if this fits into your overall retirement plan, are you just chasing a shiny object? If this investment is just the hot investment, be careful about checking the hot investments. So alternatives in general aren't bad. They're just not for everybody. They're definitely not a magic solution. But if you've got a solid plan, you want to diversify a little bit out there, and you understand the risks that are associated with it, these are things that you can consider in your plan. But just remember, boring portfolios retire people. Exciting investments sometimes make exciting losses.